Hey everybody, thanks for joining me today. Today I want to talk about Intel Corporation, ticker symbol INTC. It has been a while since I've done a fully dedicated video just to Intel, and they released earnings here not too long ago. So I thought it'd be a good time to touch base on this company again, and we're going to dig into the 10Q, look at the last earnings report for them, and then we're going to dig into the financials, kind of look what they've done the last 10 years from a compounded annual growth rate at sales and earnings, free cash flow, all that good stuff. And then we're going to look at what analysts think the company's going to do over the next 5 years and what I think the company's going to do over the next 5 to 10 years to get to an intrinsic value today. And this is the first video you watched of mine. My name is Justin. I've been an accountant for almost 20 years now. Recently, I transitioned from accounting to finance, so I'm actually more in the financial planning and analysis at a public company in the aerospace industry. And I really enjoy the stock market. I enjoy digging into stocks. And if you get some value out of this video today, go ahead and smash the thumbs up button. If you like this kind of content, I encourage you to subscribe to my channel. So let's just jump right into Intel. All right, so first let's take a look at their 10Q. If you're wondering what a 10Q is, this is what the public companies have to file. If they're on the American Stock Exchange, this is something the SEC requires them to do. So the 10Q is just for the quarterly report. If you see a 10K, that is their annual report. And I got to say, Intel does a fantastic job, probably the best I've seen of any company as far as their 10Q and their 10K goes. All companies have to put certain information into their annual and quarterly reports, but the way the Intel does it, the way they format things, and there's just the information that I think they give shareholders or potential shareholders is well above and beyond expectations of SEC and a lot of stuff that I see. So they do a fantastic job with that. Now, if we go down, let's see if I can find, I think it's page 8, if I remember correctly, they start getting into the operational segments of the business. And I think it's really important to understand, how a company generates revenue, how they bring cash in, how they pay their bills and all that. And obviously that starts with the revenue side of the world. And if you're looking at a company like an Apple, for example, they say, okay, yeah, they just sell, phones, iPads, that sort of thing. But you really need to understand how that is broken up, where most of the revenue is coming from, how much each individual segment of their operational business is growing within that, and how profitable is of that. And you can really then easily or more easily forecast what the company is going to do. And there's several different operating segments that Intel has. So if we scroll down here, so they have 6 of them. So they have client computing, which they call CCG. They have data center and AI, which is DCAI. They have network and edge, NEX. They have accelerated computing systems and graphics, AXG. They have Mobileye. And then they have Intel Foundry Services, which they also call IFS. Now, interestingly enough, there's been a lot of news lately for Mobileye. They've been trying to create or spin off Mobileye, have its own IPO, so that way it can become its own public company. And I can't remember the exact number. Someone can correct me in the comments or not, but I know that they bought Mobileye, I want to say like around $10 billion, and they're trying to spin it off at a $50 billion IPO, and they just bought Mobileye a couple of years ago. If they can actually do that, that looks like a very favorable position for Intel shareholders if they can do so. Now, they haven't officially done that yet, and I don't think it's a really good environment to do that right now. You look back in 2020, 2021, a lot of companies were doing a lot of IPOs or SPACs at that time. That has really cooled off lately with the inflationary times, potentially going into recession. Obviously, the market is pulled back a lot since the beginning of the year. So this may not be the best opportunity to spin off, say, a Mobileye. They're not going to get the kind of money they did, say, a year ago. But that'll be something, I keep on to in that. But out of these 6 divisions, now I will say they do have a 7th they don't list here, and that's kind of the other. So everything that doesn't fit into these categories goes into an other bucket. So they technically have 7, but their main 6 businesses they have are here. So the next step, you really want to understand and know like how or what is the operational income or margins for these businesses. And Intel does a great job. They easily break it down for you. A lot of companies will break it down, but you have to really dig into the financials, and some of them simply don't. And you have to be really careful with holding companies in particular who hold a bunch of different companies, what are those businesses? How are they performing individually? It's really important. So, for example, they break it down here by their operational segments of the business. They break it down by revenue over here on this side, and then they go all the way down. They talk about operating income here. So you can actually see that 3 out of the 7 of the businesses here, or the ones that we saw before, there were 6 of them. 2 of those 6 we saw before are not profitable. So the Intel Foundry divisions, which they started not too long ago, they're ramping up. It's probably going to take a while for them to become profitable anyway. And they have accelerating computing systems and graphics. They lost $390 million. What's interesting about that one is that that side of the business only made $219 million in revenue, and they lost $309 million, so $90 million. So that's not really good, obviously. But their big segments of their business are client computing and then data center. So client computing and data center and AI, you're talking, roughly about 4 million, a little over 4.5 million or 4.5 billion, excuse me, for their total operating income. In fact, those 2 businesses themselves are the entire operating income of the business, if you think about it, because if you add those 2 up, that comes to about 4.5 billion, and their total operating income was 4.3 billion. So it's just kind of interesting. And if you actually dig into the 10K itself, I'm not going to go through every single one of these. They actually divide those businesses out. I can't remember what pages they're on, but just know that they actually divide them out. And so, for example, client computing and data center and AI specifically, one of them has 28% operating margins, and the other one has 30% operating margins. And historically, Intel has been around 28%. So that's what's really generating their operating income of the business and their operating margins of the business overall. So just something to be aware of there. Another thing to talk about, so their Q1 2022 earnings deck here. I have to say, there's no 2 better managers or leadership team executives that are leading a team right now than, say, Pat Gelsinger and David Sinzer. Pat Gelsinger has been with the company for almost 4 decades. He did a small stint with VMware a couple of years ago. Came back to Intel last year. He actually won CEO of the year in 2019 while he was at VMware. He's won all kinds of accolades. It's very apparent to me that he's very, very well liked in the industry. And then David Sinzer, I usually don't care much at all about chief financial officers, even though I'm an accountant myself. But he was at Micron before, and Intel stole him. I'll say stole him from Micron. But if you go back and look at Micron's presentation, David Sinzer is a huge part of that. It is very, very rare for a company to spotlight the CFO like companies do with David Sinzer. So I think he is very, very also well respected and really, really helps. So I don't think there's a better 2 that can really turn around Intel, because Intel has really had a difficult time, especially with AMD going head to head with them. Now, if we go and take a look at kind of where the business is right now. So right now, the company's around a $178 billion market cap, around $175 billion enterprise value. That's not correct. So it's interesting. I was pulling this from Ticker Terminal, and they're showing a negative $3 billion net debt, which is not correct. So actually, it's more like, I think, doing this on the fly right now. So I think their enterprise value is closer to $208 billion. Stock price as of today is around $44. It's kind of been around 43, 44 the last couple of days. About 4 billion shares outstanding, 120,000 employees, $77 billion in revenue, trailing 12 months. Then they kind of got some different factors down here, multiples, all right? And as far as competitors go, now these are not direct competitors other than, say, like AMD, Qualcomm, Skyworks Solutions kind of do different things. But you kind of see how the operating margins kind of fall out from these businesses. So Intel, for example, 54% gross margins, 27% operating margins, 31% not net profit margins. And this is based on last quarter. So if you look at from quarter to quarter, it's probably could be a little different, but you can see Intel looks very favorably, certainly the last quarter, in comparison with these other companies. But AMD specifically has been eating their lunch over the last couple of years, and Intel has been struggling with that. It's one of the reasons why they recruited Pat Gelsinger to come back to the company, kind of turn it around. Now, if we go take a look at kind of what this company has done the last 10 years historically, So what I did is I looked at the income statement and the balance sheet. And I took a lot of these metrics or numbers, and I dumped them into graphs to kind of see what the trend is. So what I want to see is kind of like, okay, how's the company trending? Are they going? Is it things going up? Are they staying the same? Are they going down? Kind of what's going on there. So sales on the left-hand side, earnings per share, and this is on a per share basis. So I'm factoring any issuance of shares and also buybacks. It's going up, trending up for sales, trending up for earnings. So that's looking pretty good. Operating income per share is also going up, so that looks good. Free cash flow per share. Now, it has dipped the last couple of years just because they are putting so much money into their foundry businesses, trying to grow for future growth. And sometimes when companies do that, they have to sacrifice their free cash flow in order to do that. In fact, if you look at Intel, trailing 12 months, I think they're around like $11 billion for free cash flow. I would say more of a normalized for them would be in the $16 to $20 billion range, but they're putting a lot of money back into their business right now for future growth. This book value looks beautiful. I mean, this is like perfect trajectory up. ROIC, ROE, fantastic numbers for Intel. I like to see 10% or more. They're well above that. I mean, from 10 to 20% ROIC, ROE, from 14 to 28%. Absolutely amazing. Long-term debt, this is a little deceiving. So they've been, and this is basically looking at long-term debt versus free cash flow. I like to see them be able to pay their debt within 3 years based on free cash flow. And you can see the last 2 years, it's really ticked up, but that's because their free cash flow has dropped because they're putting money back into the business. I think a normalized long-term debt payoff number would probably be around 1.5 to 2 years for them. So I'm not too concerned there. Gross profit margins have been going down from 62% all the way down to 54%. Literally every year it's been going down. And that could be of concern. But if we look at the operating margins and net profit margins of the company, we're not really seeing that. So operating margins are pretty much staying the same. Net profit margins have been going up. So even though that their top line, their cost of goods sold has been increasing compared to their revenue, we're not seeing that flow down to their operating income or their net profit margins, at least here. So that's a good sign. Enterprise value to EBIT ratio. I love this ratio even better than the PE because it's looking at total enterprise value, which incorporates any debt or cash the business owns. And then looking at operating income. And over the last 10 years, it really looks like their average for them would probably be around a 10 to a 12. EV to EBIT ratio, and right now it's trading around a 9. So that doesn't look like it's really good value right now. But we look at a PE ratio, it's kind of different. Historically, they've kind of been around, say, 14, 15, maybe even down around a 12 here the last few years. And right now it's trading around, looks like a 7. So historically, the PE looks really, really good. Now, there were some things over the last year that kind of inflated their PE a little bit. So you kind of have to be careful with that. But from that standpoint, it does look interesting where I would say EV over EBIT, it looks pretty average compared to where they have. Big dividend company, keeps paying dividends year over year. That's been increasing. I think their dividend yield is around 3% right now. So they're a fantastic dividend payer. And they've been buying back shares. So they've gone from 5 billion shares down to 4 billion shares, which increases value for shareholders, which is just absolutely fantastic. Now, if we take a lot of these numbers and then we dump them into this spreadsheet I'll show you, it basically takes these metrics and then looks at them at a compounded annual growth rate. So it kind of gives us a better picture of kind of what's going on. So for example, make this bigger real quick. All right, there we go. All right, so sales per share, the growth has been 10% per year for this, or excuse me, 6% per year over the last 10 years. Earnings per share has been 10% growth per year over the last 10 years. Operating income 5%, free cash flow 4%, book value 9%. I like to see 10% or more is what I'm looking at. Certainly for earnings, it looks like that way. The other ones are no. However, book value would be more than 10% if we actually looked at it. If we didn't factor in those buybacks of the company, that would actually be higher. And then ROE, average 24% last 10 years, 18% for ROIC, fantastic. Debt payoff right now is over 3 years, but like I said before, I think more of a normalized debt payoff would be 1.5 to 2 years for this company. All right, and now let's kind of take a look at what analysts think this company is going to grow. And we kind of see the numbers, and this is over the next 5 years. So they think it's going to grow 7% sales per year, net income 4%, operating income 5%, and then free cash flow 19% per year. And if we go look at these, dig into them a little more here. All right. So the analysts, think it's going to grow from 75 billion this year to 105 billion about 5 years out. In fact, if we go take a look at the full year guidance for this is out of their last earnings report for Intel. So they think full year guidance will be around 76 billion for revenue for GAAP perspective. Gross margin around 49%. So they think their gross margins are going to continue to drop. Earnings per share is going to be around $4. Capital spending, 27 billion. Interesting. So they're saying 76. So it's pretty much in line with analysts thinks. Analysts think around 75.5 billion. So pretty darn close overall. So over the next 5 years, so it's about 7% CAGR or compounded annual growth rates. And if you're kind of wondering what these numbers over here, that's based on from 2017 to 2026. I think that's probably a 9-year, maybe a 10-year. That'd be, I guess the next 5 years and the last 5 years, it looks like overall. So EPS gap. So the company thought they would be around, what would it say, four something, right? $4.19 for GAAP EPS. Analysts think the company's going to be around $3.94. So analysts are not as bullish, but pretty darn close, not too far off from that. So that's kind of interesting. And we look at what analysts think as far as street targets go. So right now the company's trading at $43, $44 around there. They think the average analysts think the company should be worth $52 right now, with a high of 72 and looks like a low of 33. Most of the analysts following the company, 22 of them say it's a hold right now. There are, it looks like 33 roughly analysts following the company. So a good number of analysts are following the company right now. So at least from the estimates that are coming up with that we're seeing here, it gives me a pretty good feeling that there's enough analysts following the company that I think it's going to be at least somewhat legit, or I would actually lean on these as being correct going forward. Obviously, it's not going to be perfect in every scenario, but if you're following a company that only has 5 analysts, it's a lot different than a company that has 33 analysts following it overall. So interesting. So they do think it's undervalued from where it is at this standpoint. All right, so now let's go calculate the intrinsic value of Intel, and I'll kind of walk you through how I'm doing it here. This is a different type of valuation than I normally do. It's a little more complicated than I've done in other things, and I tend to lean on Phil Town and a lot of his valuation that he does from 10-cap valuation, payback method, and then also earnings per share valuation that he does. This is another one that I like to do. Again, it's a little more complicated, but it really forces me to dig into a company and really understand how their internal workings of their operational side of their business is. Like I said before, it's really good to understand how each business is growing and what the operating margins are and where they're going to be at in the future. And then from there, you can figure out, okay, what's the future earnings of the company, and then discount it back to today to come with an intrinsic share price. So basically what I'm doing here is I'm taking, the last 5 years of sales for the company. You can see their growth rates over here year by year. Then we have analyst estimates for the company over the next 5 years. And you can see their growth over here from 1%, 3%, 7, 13, 11. And so if you look at historically, the company has grown 6% per year on the top line, which we saw in a previous slide. But what I'm doing is saying, okay, I'm going to be conservative here. Okay, if they're going to be 11% growth, 5 years out into the future, keep in mind this company's a $200 billion company. As they get bigger, it's going to be harder for them to grow. So I'm going to start backing off that number. So I'm going to say 8% growth in 2027, and then 6% in 2028, then 5%, 4%, and then 3%. So they've grown 6% in the past per year, and I'm going to say they'll grow another 6% going forward. That's kind of how I'm looking at it from there. Next up, what I'm doing is figuring out, okay, what is the operation margins of the business? So I'm really looking at operating income on this analysis. That's what's really important to me. So I'm looking at what analysts think this company's going to do over the next 5 years from an operational margin standpoint. So keep in mind that the company historically has been around a 28% operating margins. It's kind of dipped here here recently, but I do think they can get back somewhat to there or close to that. Again, I'm being conservative. So analysts
I'm going straight, these first five are straight off analysts. So 22% operating margins in 2022, then 22% in 2023, then 21%, 26, 27. Then I'm saying 25% 5 years after that. And so based on that, I come up with a future intrinsic enterprise value of $541 billion and a future stock price of $124. So based on a multiple of a 15, I come up with an intrinsic share price of $48 for the company, which is a 9% margin of safety. Now, there's a couple of things to think about here. So, first of all, I should say this is just my valuation, so don't trust this or think this is gold. Do your own due diligence. This is just how I'm looking at the company and doing my analysis here. But a couple of things here I want to point out. So one, I'm not factoring any dividends, and the company has been paying out 3% dividends. And then two, I'm not factoring any share buyback. So why do I not do that? Well, when companies start going through financial problems, the first thing they do is they cut back on share buybacks, and one of the next things they do is cut back on dividends. There have been many companies that have done that. I mean, Disney, for example, cut their dividends. Boeing cut their dividends and their share buybacks. You never know. You think a company's doing amazing. They're always going to do amazing, and stuff happens. We're a capitalistic type market, and companies come in and they take share like AMD has done, and can Intel, regain some of that? We'll kind of see. So if you're someone that is a lot more bullish, maybe you say, okay, they're going to continue growing. They're going to grow again at 11%. 10%, maybe trickle down just a little bit. Here, you're going to think that their profit margins are going to be more like 30%, and this is operating profit margins. That puts their intrinsic share price around $70 based on a 10% return or IRR. And so that looks obviously more favorable. So it kind of depends on how you look at the business and what you think. For me, I always like to be conservative. I also like to be as accurate as possible too. But that's kind of where I'm at. Now, if you also think they're going to continue doing share buybacks, that would change that number as well. But I do think Intel is intriguing. It really is. Again, I think they have a fantastic management team. They obviously have some type of moat, especially with pricing going on, with the type of operational type margins that they have had. Hopefully they can get back to the historical of 28%. If they can do that, the stock looks very, very good today. Another thing I want to point out too, so this workbook that I have here, I do share this with my Patreon. So every time I post one of these stock analysis videos, I do post this full workbook, and then also if I have a presentation, I post that as well too. So has a lot of good stuff, information in here. If you're interested, go check my Patreon out. I'll have a link down in the description below. I have 4 different valuation templates that are in there too that I share with my Patreon, so they can use to go value their own companies and all that good stuff here. So definitely go check that out if you're interested. I'd love to see you over there. I also have a Discord channel as well that you get access to from Patreon as well. So thank you so much for watching this video. If there's any other stocks you want me to analyze, drop it down in the comment section below. I read every single one of these. Again, I think Intel is in pretty good shape going forward, and it does look interesting today. I don't think there's a huge margin of safety based on my valuation for Intel right now, but interesting, very compelling overall. Thanks again for watching. I'll catch you on the other side. Take care and God bless.